Is the Fed on hold? Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with George Goncalves, Managing Director and Head of U.S. Macro Strategy at MUFG. Hey, George, it's great to have you back on.
Good to be back out with you, Maggie. How are you?
Good. Thanks, everybody, for your patience. We had a little bit of technical trouble. It happens, but magically, we have George with us. So thanks for hanging with us and being patient. Thanks and welcome to everyone who's joining us live on Substack and YouTube. So, George, we are all on the edge of our seat waiting for Nvidia earnings, which are coming out after the close. Ahead of that, U.S. stocks gained some ground, although a lot of people were pointing out that the breadth was pretty anemic. Crypto remained under pressure, which was interesting, maybe an indicator of risk appetite. Bonds were sideways. What is your sense of where we are right now? I mean, I know you sort of concentrate a little bit more on bonds, but everything seems to be orbiting around this AI story and Nvidia. Is there any way these AI names can beat or live up to these lofty expectations out there?
Let's see. I mean, obviously we're all watching the headlines later on. We'll see what happens. But I do think that the time of the year, the rates component does play a role here as well. And and there's been a lot of Fed cut expectations priced out, and so we're in this interesting period that if we don't see the equity market rebound and start to kind of head back higher again, and people take some chips off the table, and if the Fed were not to cut, I mean, that would be like the perfect storm into the end of the year. Like historically, everybody is banking on a year-end rally, but what if that happened already? What if that took place during September, October, early October?
Yeah, it does seem that sort of from a sentiment perspective, there's a lot more nerves and concern out there. We had the Fed minutes released today. I mean, I know we're all obsessing about Nvidia, but the Fed minutes came out. We're in this weird environment where we don't have all the economic data. What jumped out at you? Where do you think we are in terms of Fed policy?
Look, I think the Fed wants to buy optionality. We thought, and we'll still see what happens with the data that we get and before the next Fed meeting in December. But it's clear that they want to buy optionality. The market was pricing in too much certainty in late October, early November, and now we're less than 50-50 for a rate cut in December. We're at really 30% roughly from what I last checked for a December cut. And I'm still of the view that they should be cutting. Labor market conditions have been getting worse while we've been on in a holding pattern, flying blind without data, but yet the sentiment's been bad. The layoff announcements continued all throughout the last 6 weeks, and government being closed actually took away some activity from the economy as well. It has a knock-on effect. So they should be cutting, but from what we got from the Fed minutes, many were not really convinced that they should be cutting in December versus several that think they should, and many outweighs several, at least for now. I think they should be cutting, but based on the rhetoric as well as the minutes and the sentiment lately, they're trying to push back on cuts.
Yeah. So you think they should be cutting because you're worried about the labor market, or is it more broadly the state of the U.S. economy?
Well, the labor market drives everything. I mean, until one day the AI, if it ever does, we'll see, takes over the labor market. But it's the jobs market, it's household spending, it's consumers, right? It's still 70% of the economy. So if confidence is dropping there, if the consumer's tapped out in the lower half, as we all know, it matters. So I mean, the jobs market to me is the most important thing. It trumps everything else.
What do you make of the inflation side of the equation? Is that what's holding the Fed back? And do we have an inflation problem?
I think that inflation plays it's a nagging role. It's playing a nuisance, and it's maybe confusing where we are, and it's causing the Fed maybe to have doubts because they clearly missed it on the upside last time, and they're trying to avoid that. I think it's a little more simpler than that. They don't know what the neutral rate of interest rates should be. Should they have rates at 3 versus 4, and that's that range where they're debating amongst themselves. I think market largely agrees with my view, but it's been taking out these cuts. But 3% is probably the sweet spot for interest rates. But the longer they take to get there, I think it's going to cause problems. But I think there's that internal debate. They're trying to figure out where is neutral, where should they land, and maybe they want to slow it down because they don't know where they are right now.
Yeah. You bring up a really good point though, that suddenly now with the Fed in play and maybe not cutting, and if you see a wobble in the market, uh, you're now sort of talking about both sides of the K economy, right? Because it had been all those asset owners and that wealth effect that had been propping a lot of spending and a lot of the economy up. I mean, if we
Absolutely.
start to see that deteriorate, where does that leave us?
Yeah, no. Look, I think it's the the market drives the economy, not the other way around. It's been like that for quite some time, and yeah, financial conditions tightening would take a toll on spending. I mean, I'm not sure if we're able to share charts. I think I sent you over some stuff. I'm not sure if I can pull it up myself. I'll
Yeah,
try.
I don't know if you can.
I'll try. Let me see if I
Let
can
me see. If you try, we'll
share
experiment in real
screen.
time.
Let's
I
do.
think we would have had to have loaded it actually. I think we would have had to have done that before, but you can
Maybe.
talk through it and we'll put it in the chat after.
I don't know. Let's see. I got something here. Let's see if it works. Hold on. Am I sharing?
Yes, wait. There, wait. No. Yeah, there
You
we
got
go.
nice. Okay, there we go.
Fabulous.
I gotta share because you brought up the K-shape, which has been a big focus of ours, and most market participants have been well acclimated to what this concept means. But for me, like it comes down to this kind of circle that you're seeing here, the outer bands, the outer circles of job growth, wealth effect, spending goes into like the other side, which has been keeping the economy going, which is AI, CapEx, PC is private credit. As long as that circle is going, we have growth and the economy is okay, not great. It's obviously disproportionately benefiting a few more so than the whole, but it's enough to kind of keep the economy going. You break this dynamic, what you have is the inner circles, which is what if you get non-performing loans like NPLs, just for abbreviation's sake. You get a reverse flow if equities actually start going down and people start to see, if there's less jobs, less passive flow going in, people are retiring. So we have this kind of like counterbalance that could start to matter. So yeah, I am worried about the financial markets tightening, resulting in less wealth effect, impacting overall market valuations.
Yeah, this is the sort of the knife's edge of a very financialized economy. And I think what you said, reverse flows in retirement. Talk to me a little bit about that because there are a lot of people. There are some people who've been pointing out this demographics, and I think Mike Green is one of them. That what if we get from a period where people are buying assets to build those next nest eggs, and then they start selling them because they need the money, right? They're living off of that retirement income, and this is sort of the baby boomers fully entering retirement. Some of them are in it already, but really needing that money, especially as their lifespan increases. Is that do you think about that? Is that a negative, sort of that constant negative it's kind of the reverse of the passive, right? That constant selling pressure rather than the constant buying every dip from the long hands that we've become accustomed to. Is that what you're talking about when you're talking about retirement flows and reverse
Yeah,
flows?
that's right. That would be the reverse flow of job growth results in Mike Green's been obviously all over this since the start, and he's the foremost expert on this. But you get a job, you contribute to your 401k, and that goes into the market. As long as you have more people entering into the labor force versus people leaving the labor force, right? As long as there's more entrants, then you keep that outer circle going. Wealth effect feeds on itself with spending. It's just kind of that virtuous cycle. In reverse, it should operate very similarly. It's very mechanical, as he's been highlighting for years. So yeah, I am concerned that if you have less job growth and retirements continue, then you get the selling effect, right? And it's no longer passive that's dominating.
Yeah, which I think is a worrying backdrop, especially when we stack up all the other things to be concerned about. So, on balance, are you more concerned about risks and are you concerned about the bond market, or do you feel like equities outstanding, that we might be in a little bit of a fog with Fed policy, but we're on pretty solid ground? How are you feeling about the balance of risks?
Look, I think at this stage, after what has been an amazing year for most asset classes, the last week and a half notwithstanding, it's been choppy and of course down a little bit, but we're still up a lot on the year. Credit's done well. even Treasuries rallies throughout this period. Like everything pretty much except for the dollar. Crypto's given back a decent amount of gains, and I think that could be pointing to what people call the 4-year cycle. I'm not a crypto expert in that area, but I think it's also picking up on the fact that there's less potential easing, at least right now, and even if you think about the fiscal support that's going to kick in 2026, it's probably not big enough to actually move the needle. So yeah, I am concerned that we priced in a lot of good news. That's been the case for the last month and a half. And I brought up the concept of seasonals, or the concept of like perhaps we don't get the end of year rally, and we had it already, because typically or historically you've seen like September being a weaker month, but September was a pretty good month this year. So what if we get the opposite? Like September was good, the beginning of October was pretty good, and the last 3 or 4 weeks more choppy. If we don't get a follow through up, and we'll see what happens in the next 36 hours into option expiry and into Thanksgiving, and then we have month end. And if we don't have enough data, and let's say I'm wrong and the Fed does not cut, that's a very bearish outlook, right? So, I mean, I think there's enough evidence that they should be cutting, but if they're hesitant for whatever reason, because it's foggy out there, they don't have the data, and they hold off until next year, it could end up being a rough end of year close.
Yeah, and you're right. Seasonally, it happens, but we've seen it before. There are years. I think 2018 was one of them. But folks have been pointing out that it's not impossible for that to happen.
Yeah.
Trump came out today and said again that he'd love to fire Powell, and kind of indicated, at least the impression people got from the comments was that it was Scott Bessent that's sort of holding him back from doing so. Are we sort of setting up? Is that just noise coming from Washington and sort of Trump sort of, expressing how he feels, but, and maybe just sort of the optics, but not reality? Or do you think there's a real threat that he could act on that if he gets frustrated, if we do not see a Fed rate cut? And what does that kind of change do?
No, if anything, it's just more venting than anything else, and just expressing, an opinion and a view. It's posturing, and I think it's also very, everything's very calculated, right? If the Fed does not cut in December and the market goes down, clearly policymakers and politicians, including President Trump, are not going to be happy, right? So it kind of at least pre-positions to say, hey, you should be cutting, you're not cutting, look at the damage you're creating. So it could be some of that, which is why we think that this is more about trying to figure out who the next Fed chair is going to be. I think the bar, we've more than established that it's going to be very difficult for the president to actually, not we, just collectively, in terms of those that have looked at the options of being able to remove someone like a Fed chair is pretty much very hard. So it's more about what happens if they don't ease, what is the reaction in the market, and then who's the next Fed chair that's selected, and the timing of that selection. So my personal view is that if they cut in December, that takes some pressure off of the Fed. But if they start, if next year, let's say there's slightly higher inflation, Powell has 3 more meetings next year. He has before his term is up in May. If they don't cut next year for 6 months, then we're going to have some real big problems, right? Because everyone's banking on these cuts. Valuations are banking on it. The bond market's banking on it. So you can almost have the opposite, where everything rallied this year, maybe the first 6 months, first 3 to 6 months, who knows exactly when, you can have a situation where everything either heads lower or doesn't perform because the Fed's not cutting because of whatever reason. Yeah. I think it's more, again, I don't want to go into the politics, but I think it's more about the posturing, about getting some sort of a head start. If the Fed doesn't cut, you can kind of lay blame there.
Absolutely. The finger pointing, right? You've already identified it's going to be their fault. And which we know in Washington, everyone loves to do, no matter what side they're on, is have a scapegoat. The Fed rate is one tool, but they also have their balance sheet, and there have been, I know you're probably watching this closely. I saw you had some charts. There've been some concern, people that I'm talking to, watching the repo, what's going on in the repo markets, and there's been signs of strains there. There's been some concern. Is there a situation where the Fed leaves rates is on hold, leaves rates unchanged, but actually starts doing something with the balance sheet in order to provide some liquidity and support, they must be watching what's happening watching in terms of what is happening in these lending facilities.
No, I think the Fed over the last number of years has, you know, gained further insights into being more surgical with like administering easing or liquidity. You saw it after SVB. You saw it after like, you know, the regional bank crisis. They came up with a bank term funding program, which ballooned their balance sheet even while they were trying hiking rates, right?
Mm.
So like the old rule of thumb was like, oh, the Fed can only do QE when rates are very low, or some version of liquidity injection when rates are very low. That's not necessarily true. We have now created a more ample reserve banking system framework that if they need to inject more liquidity, they can actually start buying some securities, you know, more strategically, more surgically, without calling it QE. But even then, I mean, you start setting like kind of conflicting signals. If the concern is about, you know, balance sheet availability for the broader banking system at a time of year like now, why not cut and then skip cutting next year, and you get to take a break? I feel like they wanted to buy optionality because in October the market was pricing 100% chance of a cut in December. Now it's down to 30. I think if we start to see market fragilities, if liquidity gets more challenging into the start of December, and if the data's not great, I mean, the data's not turning. We're going to get NFP tomorrow from September, but that's going to be such old news. But in general, like even the private sector data is weak enough that they should be cutting. So if they don't cut, and then there's these like liquidity problems or potential liquidity issues happening into the end of the year, that's further reason why they should be cutting.
Yeah, absolutely. So Nvidia's out. Somebody, thank you, just pointed out that it's up 4%, over 4%. Earnings were 125, the estimate was 117, folks. And revenue was right around expectations, a little bit higher, 54.92. I think the estimate was around 54.59 or 54.60. So that part looked like it was in kind of in line. I will say that I think a lot of this is going to ride on what we hear from them, not just what those headline numbers are. There's a lot of concern about CapEx and what the sales backlog is and all of that sort of, access to markets. So it'll be super interesting to hear how the conference call goes down. But so far, so good. Just back to bonds, George. So just to be clear, are you concerned about the financial plumbing of the global system and liquidity? Because we're sort of seeing everyone's kind of waiting for that Fed rate cut, but the longer end of the bond markets haven't been responding to any government action. They're all looking at this sovereign situation, and it seems like they're growing increasingly concerned about these debt levels. Do you think it's manageable, or do you think we're starting to see strains that are more serious here when it comes to global bonds?
Yeah, I think that's a good point, that you're differentiating global bonds versus just the Treasury market, or and one can drag the other. So the potential for other sovereign markets coming under their own sort of pressure. If you look at what's happening with Japanese long-term rates, look at what's happening with European rates. If these local investors outside the U.S. now have an alternative to U.S. Treasuries that might keep capital there, or might force at some point some repatriation of capital back to their home countries. We haven't really seen that in the numbers of the data, so it's more the fear of that potentially happening. But it is related to this concept of fiscal debt sustainability. Like, can these large sovereign countries that have a lot of debt and versus their GDP and have been using debt to continue to expand their economies for the last 15, 20 years, are we getting closer to the end of the road? And that's the concern. I'm not sure if I can go back to the chart book. I'm not sure if it turns back on by itself or not, or if we have to
Something
turn.
will happen. Go ahead and give it a try.
Yeah, let's see. All right, I was on before, and then there we go.
There we go.
Yeah, no, because we're talking about like just market dynamics in general, which the markets themselves are displaying K-shaped sort of divergences as well. You look at the chart on the left. This is, of course, looking at black line Mag 7 versus overall the rest of the 500 with the 493 total return, and you look at like copper versus gold ratio, these things used to correlate with each other and they're not. But the chart on the right is looking at the 10-year Treasury versus the Japanese yen, the JPY, and that also has been diverging lately too. So I think people have to be watching what's happening in Japan with the yen and with treasuries. If this were to kind of relink again, then you would see some sort of like move in treasuries higher because Japan is a big buyer of U.S. debt, and so if they have an alternative, and if they were to lighten up on buying U.S. debt, rates in the U.S. can also go up for those reasons too.
Yeah, and it kind of feels like people pointed out that ever since the Fed started cutting, we haven't seen any reaction in yields. It doesn't in the sort of longer term, longer end of the market in duration. So who's buying? Who's the buyer of treasuries? Who's the future buyer of treasuries?
So the future buyer of treasuries is U.S. investors, and I do think that like there's obviously a huge focus on stable coins and what that might do for providing another marginal buyer of treasuries. The banking system, the deregulation that still is coming down the pike could open up some marginal support for treasuries. But we're really hanging our hat on a reinvigorating the domestic buyer base of treasuries, which at times comes back in and supports the market and has been shifting away from foreign investors more to local investors. But yeah, we're going to need all the helping hands we can get, and so I think we're going to see some both policy changes, maybe stable coins start growing, become a bigger part of the overall financial landscape, the banks, and then just investors when it's opportunistic, when they feel value there. I think that's and again, if equities go down, like in this weird period, if equities are like up and down 5%, maybe even 7%, it won't engender any demand for treasuries because there's so much. We're still concerned about the overall fiscal outlook in the debt, and you're right. The Fed has cut rates, but the beta or the sensitivity of like long-term rates to the Fed has been loosening and getting weaker. However, if equities were to go down like 10 or 15%, I still think that would create flows into bonds. So be careful what you wish for, because like that's like a negative outlook, right? You don't want to see risk markets to have a big correction in order to support the bond market, but that's one way you can get it.
Yeah, that's super interesting because I mean that would suggest that they're still considered a safe haven. There've been people raising the question that are they like will we see people just rotate into gold or hard assets or even crypto, even though it's been very volatile? Do people feel like treasuries are still a safe haven? It sounds like you think they do.
No, they do. I mean, I think it's more about valuation or like what you're getting paid for, and that's why 10-year rates or just long-term rates have had a hard time participating with the rate cuts and declining as much as short-term rates. But like there's no market that's big enough that can absorb capital. If there was a real clear shift out, gold market's not big enough, crypto's not big enough. So yeah, if it's going to be like a move into dollar and into treasuries, it's still going to be the place where the safe money goes.
That's a great point about the sort of depth and liquidity of the U.S. Treasury market. Are you surprised that high yield spreads have hung in here? This is one of the things that's sort of a head scratcher for a lot of people who are a little bit concerned about the outlook and anticipating volatility. And then they look at that high yield spread and they're like, it's been pretty well behaved.
Yeah, I definitely am. I have another chart that we can pull up really quick if you want to flip that back on. You can see this is comparing high yield spreads, the red line, relative to corporate debt as a percentage of the value of the equity market. So basically, like the equity market cap keeps getting bigger, and so from like a debt to equity perspective, your debt loads are manageable. So like if you're using equity as like your form of kind of like denominator, then maybe credit is okay. But this is why, like you mentioned before, we've financialized everything. We have an economy that's so dependent on equity markets never going down. The same thing is true for high yield. So if we were to see a more proper equity correction, high yield spreads would widen with it.
And what is it's so funny you just said that sort of it's an environment we can't tolerate really though. So do we see it get to that point? Is there some sort of, I don't know if it's right to say a Fed put, but is there some sort of, combination government put underneath these markets because we just can't afford to let any of them go down
I mean,
substantially?
yeah. So like, I mean, like, there's history never repeats, but just kind of like we like to look at comparisons and think about the past. Ironically, like, again, we have a view the Fed should be cutting, and we think they should cut in December. But if we're wrong and they don't cut, and the rest of the market, those that have that share that view have that, that same experience, it's gonna feel like as if they hiked. It's almost like everything's opposite to the way that we've been used to. And if you go back to like March, May 2000, if you go back 25 years ago when equity markets were at the highs back then, where Cisco was the darling, when everything we were all enamored by networking and the internet. And yes, we can argue that the companies now have cash flow and earnings, but they're also using that and now also moving into debt. If you think about like that parallel, the Fed not hiking now could be almost like that top tick of 2000, right? If they were to go on hold for 3 to 6 months, it would feel like a lot of tightening, similar to maybe 2000.
Again, setting up for a pretty precarious situation. So what do you guys like here? What do you think looks like it can outperform or at least be a place to hide if it sounds like there's a lot of risks out there. It sounds like you're describing a lot of risks. So what do folks do?
Look, we've been arguing for the last 2-3 weeks to get defensive, raise cash levels. At a minimum, you can think about picking your spots in industries. Like, the year is almost done. Again, we have Thanksgiving next week, as everyone knows. We have the Fed meeting, which happens earlier in the month than typical. They usually meet at the middle of December. They're going to meet in December 10th. So the year is basically done. Like, most investors are probably kind of just squaring up positioning and their portfolios for next year. So I think just kind of building up some dry powder, thinking about what sectors you like for the next year, because the year is basically gone. So cash, short-term treasuries, high-quality credit, up in ABS, high-quality ABS, AAA, like very defensive. Get over the hurdle into next year, and then let's see if we actually do get the sort of growth that's been promised, and the Fed keeps cutting. But again, I'm playing the risks that they might not cut, or at least I'm highlighting them.
Yeah. What are you concerned about private credit? Because we've seen, that Blue Owl, there was a lot of attention on the Blue Owl deal. They were going to combine it, and then they backed off of that today, I think, because of protests from shareholders. And there are a lot of people worried that maybe there's risk lurking in a part of the market we don't have a lot of transparency into. Is that something you worry about, or is that a risk on your radar?
Yeah, no, it is. I think you can go back. I'm going to turn back on the slides again. This is kind of looking at, and maybe you can zoom in later more when you kind of crop this thing, and you can look at, most of the chart on the left here is showing a lot of the lending in the U.S. banking system has been towards what people call like non-depository financial institutions, which are basically private credit. And so and the black line is lending excluding private credit type lending. There's really very little lending happening outside of private credit. And then the chart on the right is comparing triple Bs versus like an ETF that tracks the kind of business development corporations, BDCs, which are like part of the private credit environment. So yeah, there's clearly there's some concerns around the opaqueness, what's really going on there, and that's why like it's so critical that the jobs market and growth doesn't really relapse, because it's all based on cash flow. It's based on the ability to service these debts and these small mid-sized companies that are given these sort of lending by private credit. If the consumer really hunkers down, and if we go into a economic slowdown, then these credits are going to get exposed for not being really as strong as maybe suggested.
Yeah. It's so funny. Somebody was saying, Nvidia beat earnings. Talk about that. So this is where we focus so much on equities, but can equities thrive if the bond market is not healthy? I think this is sort of an underestimated point. If we start having strains and liquidity issues in the bond market, Can the equity market continue to rally?
So that that is the multi-trillion-dollar question. My personal view is no. I think you need to have all cylinders firing in the engine. You cannot have, again, you can't have the equity market and credit markets completely going in opposite directions. One feeds the other. So yeah, I do think that if credit were to come under concerns, or long-term rates don't come down enough, or the Fed doesn't cut, the bond market I think is really crucial, especially where valuations are. Because if we had valuations at lower levels and equities were being driven purely by earnings, but you're paying up for these earnings, and you're hoping that rates are going to come down and spreads are going to stay tight. If any of those things change, you're going to have a repricing of all assets.
A repricing of all assets. Well said, George. It doesn't mean it's going to happen, but we like to talk about not only where opportunity is, but also where risk is, and sort of going into year end. I think that's super important. And as J&J says, wait for that earnings call, because it's never just about the EPS numbers, for sure. But it's going to be really important, because if they manage to deliver, we may be having a different conversation tomorrow. George, it's always fantastic to catch up with you. Thank you so much. We got to pay attention to those bond markets, and we appreciate you helping us do that.
Thanks, Maggie. Appreciate it.
Yeah, thanks to everybody for joining us today. We will be back with Dale for the residency. You'll remember on Friday, he said, as goes Nvidia, so goes the market. So we'll see what he makes of all of this as we get a chance to trade through it tomorrow. So we hope you'll join us for that. In the meantime, everybody, take care and good luck out there.